All right, M10-6 states Greener Pastures Corporation borrowed $1 million on November 1st, 2012. The note carried a 9% interest rate with the principal and interest payable on June 1st, 2013. Show the accounting equation effects and prepare the journal entries for A, the note issued on November 1st, and B, the interest accrual on December 31st. Okay, again, dealing with liabilities, one of the common liabilities that you might come into account with is notes payable, right? In this problem, it says on November 1st, we get a notes payable, or we issue a notes payable, so we get cash, right? We'll debit cash, and it tells us that it's 1 million, so we're just going to write 1 million here, right? Cash is an asset, so the accounting equation effects, obviously assets go up, right? And then credit, note payable. Note payable is a liability, so obviously liabilities go up for the same amount. This is 1 million, okay? Remember, from chapter 8 we talked about notes receivable. This is just the opposite side, right? If you, as a company, have a notes receivable, someone else out there, you know, whoever you gave the money to, they're going to have a note payable, right? So in this instance, we're looking at the opposite side of chapter 8. We're looking at notes payable. When we issue a note payable, when we send out a notes payable, right, we sign that contract, we get cash, and we owe liability back. Remember the difference between notes payable and accounts payable is that interest component. That's one of the main differences. There's you know, it's more formal agreement. There's other things that are included there, but one of the main things that you need to know is that an interest component is associated with notes payable as opposed to accounts payable is more of like a, I'll give you 30 days or I'll give you 60 days to pay me back, and then if you're late, we might talk about interest. But notes payable is a formal agreement that has an interest component associated with it, okay? So, at the beginning, there is no interest for us because we just took out that loan or that note, right? And we just now got the cash. And essentially, you pay interest because you're renting someone else's cash. And we haven't got any time. No time's passed yet for the cash. So there's no interest at that first stage of when we actually establish the note. But part B says it wants us to do the interest accrual on December 31st, okay? Do the interest accrual on December 31st. So between November 1st and December 31st, 2 months have passed, November and December. And to calculate interest, we use our formula, principal times the rate times the time. Well, the principal in this portion was $1 million, and the rate that they give us is 9%. So we'll multiply that out, and I want to pause right there to let you know that it's important to remember that when they show you percentages, percentages are shown on an annual basis. Unless told otherwise, a general rule of thumb, you can always assume that if you're given a percentage, it is a yearly percentage, not a monthly percentage or something like that, unless told otherwise. Therefore, this 9% right here, it needs to be multiplied by a time factor. Why? Because this is the interest for a year, but we're not holding it for a year at this point. This is only 2 months have passed. So there's 12 months in a year, multiply out that by 2 12s or 1/6. We should get 15,000. So we would debit our interest expense, because at this point we are incurring interest expense. That's the whole point of this adjustment. And this is essentially an AJE, right? We talked about in chapter 4 that we make adjustments. We make adjusting journal entries. That's what AJE stands for, adjusting journal entry. So if we make an adjusting journal entry for this amount, right, we debit interest expense and credit interest payable. Why? We haven't yet paid the interest out. We'll pay the interest out at the end of the note, right? But we debit interest expense because we've incurred that expense, and we credit interest payable because we will owe that expense. At some point, we're going to have to pay back that interest, okay? So put these amounts here. I'm just going to write 15K here and 15K here, okay? These amounts for interest expense, that would decrease stockholders' equity and obviously increase in expense. And then interest payable is another liability, okay? So that would increase the liability accounts. One last thing to remember. Notes can be long-term or short-term. Refer back to the dates in this problem. In this problem, they indicate that the note is taken out on November 1st, 2012, and it's due with interest and principal both being due at the same date on June 1st, 2013. Remember the difference between current and long-term. Current being a year or less, or really it's an operating cycle or a year, whichever is longer. But we can assume most people do their operating cycle shorter than a year period, so it's usually just a year is our general rule of thumb. But if it's less than a year, though, using that general rule of thumb, it is considered a current liability. And this note is considered current or short-term because, I'm going to read it short-term S-T, because it is less than that year period. But it doesn't necessarily have to be short-term. Notes payable can be long-term or short-term. You really have to pay attention to the contract. Why does that matter? Because when you're doing a classified balance sheet, remember you break things out in between current and long-term. So that's why it matters, because it depends on where you classify that note payable as either current or short-term or long-term or non-current. Okay? If you have any questions about M10.6, please feel free to let me know.